I really enjoy investing into real estate investment trust REITs. They're a little bit different than owning a business like Coca-Cola or PepsiCo, and it's very different than owning physical real estate like a single family home as a do-it-yourself landlord. All of these investments have pros and cons, but ultimately for the long term for myself, I see myself owning REITs much longer than I see myself owning physical real estate as a landlord, simply because they're not passive. Investing into real estate as a do-it-yourself investor, as a do-it-yourself landlord, is not passive. No matter what anybody says on the internet, investing into physical real estate is not passive. Investing into REITs is a true form of passive income, and I really enjoy investing into REITs. I came across this article from Leo Nielsen, My Top 3 REITs for Real Estate's Comeback. And I thought the article was very well written. There's a lot of information in here. There's a lot of good things. He talks about 3 specific companies: Essential Properties, Rexford Industrials, and Vici Properties. He goes into detail and discusses each of these REITs. He talks about the industries that they're in and real estate as a whole. And I thought the article was really good, and I wanted to share it with you in today's video. But really quick, I do want to say, if you are interested in Seeking Alpha Premium, Seeking Alpha will be increasing the price of premium up to $299 at the end of this month. So if you are interested in premium, it's a good time to lock in your price now. With using my link, you'll get it for $214. And the benefit of buying it now is when you come up for renewal in a year, you'll lock in the lower price and it will renew at $239 instead of $300 next year. Yeah, let's take a look at the article here. It's titled My Top 3 REITs for the Real Estate Comeback. And the summary here is real estate is back, with major ETFs up over 20%. While valuations are up, commercial real estate fundamentals show both stabilization and ongoing challenges. The industrial and retail sectors show promise, driven by strong demand and favorable trends. Office spaces, however, remain troubled. I've highlighted 3 REITs that excel in this market, each with unique strengths aligned to thrive in the current real estate environment. I am Leo, and he's part of the Hoya Capital here on Seeking Alpha. This is with Brad Thomas, if I'm not mistaken. So he's in the group with Brad. So the article starts off with here. Guess what? Real estate is back, baby. All 3 major real estate ETFs are up more than 20% over the past 12 months. This is entirely caused by the rally that started in April, as we can see in the chart below. So the main, REIT ETFs like VNQ, for example. And, I was looking at my REIT portfolio before recording this video. My REIT portfolio hit an all-time high this week. And so that was really cool. I mean, I have VNQ in there. I have Realty Income. I have Prologis, American Tower, and the old girlfriend that we don't talk about anymore, MPW. If it wasn't for MPW, my REIT portfolio would be rocking right now. But I'm down quite a bit. The problem is I bought the dip one too many times on MPW. When, remember when it was the buy and hold forever stock? Yeah, that happened. The only way that I can cope with this is by laughing at myself. Otherwise, I just got to mask the tears. Otherwise, I'm just going to be sad when I think about it. On the one hand, this is fantastic news, as I've discussed many REIT opportunities this year. In general, real estate investors are in a great spot. Again, on the other hand, it's not very easy to find bargains anymore, as valuations have increased substantially since April. Hence, in this article, I'll do 2 things. I'll give you an overview of fundamental developments in the commercial real estate CRE industry. This tells us where the pitfalls and opportunities are and can help us make informed decisions. In order to provide food for thought, I'll discuss 3 of the best REITs for this environment. This is based on secular commercial real estate fundamentals and the value these REITs bring to the table. I really like in this article, one of the things that, I was thinking, one of the things that I like most about this article is he gives a good snapshot, a good overview of so many different things. He talks about the industries as a whole. He gives a brief overview of these 3 different companies. But yeah, he does a good job. So as we have a lot to discuss, let's get right into it. A closer look at commercial real estate fundamentals. A few days ago, Wells Fargo published a second quarter CRE chart book, which included some fantastic insights. According to the bank, commercial real estate is showing signs of stabilization, although conditions remain soft. Looking at the chart below, we see that vacancy rates continue to increase in all areas, but retail real estate. The good news is that the rate of increase has come down substantially. That's really, really great to hear. And he doesn't cover all sectors of real estate. He's just handpicking a small few of them, but it looks like the trend is heading in the right direction. On top of that, CRE property valuations are stabilizing as the MSCI All Property Price Index has risen for the third consecutive month in July. Moreover, the transaction volume is increasing, indicating a recovery in market activity. The market also benefits from fewer banks tightening lending standards, which is good news for liquidity. However, on a quarterly basis, year-over-year prices are still down in all segments except for industrial real estate, which is witnessing a reacceleration in values. So yeah, I really like industrials. Let's take a look here. So moreover, because the good news is mainly green shoots, the bigger picture also shows rising delinquency rates with higher default rates in every single segment except for hotel real estate, which is still recovering from the pandemic. Now let me add some color to the individual CRE sectors using the table below. In the multifamily segment, demand surged driven by poor affordability in the single-family housing market. This also kept the vacancy rate stable at 7.8%, rent growth at a modest level of 0.9%. I expect this to continue as the mix of elevated housing prices and high rates has done a number on affordability. And so he has a screenshot here. Let me see. I can't click on it. So you can see here the delinquency rates for multifamily are trending in the wrong direction these last couple of years and last couple of quarters. Office REITs are just abysmal. They're just in the dumpster. And then you got retail, which has been actually doing very, very well since the end of 2021. Retail has fully recovered, even almost back to pre-pandemic levels, which is great to see. And industrials have done well, but the last couple of quarters have trended down, and hotels doing good. In the industrial segment, demand was strong. However, new construction pressured the vacancy rate and caused rent growth to soften further. However, according to other research reports I have read in the past few months, I believe it's fair to assume that we can expect a recovery in the first half of 2025. Retail continues to see strong demand despite very poor consumer sentiment. Quick service restaurants, discount groceries, and other affordable and essential platforms are doing just fine. This also explains why vacancy rates in this segment are not rising. I also believe that favorable supply plays a major role here. The office segment remains a dumpster fire. There is no other way of putting it. Although absorption improved a bit, overall leasing demand remained weak. Vacancies are still an issue, and it's unlikely that central business districts will recover soon. Even worse, a significant amount of pre-pandemic lease space is about to roll over. Office REITs, man, like that is, if you're in office REITs, you're just holding on for dear life. I just don't see how. It's tough. Office REITs are tough. Let's see here. So where to put our money? Essentially, all real estate sectors bring something bullish to the table. However, I decided to leave out multifamily housing as I'm not a huge fan of the risk reward of the nation's largest multifamily REITs. I picked three other areas. In the industrial sector, secular growth remains strong, fueled by e-commerce and economic reshoring. This keeps demand for warehouses and logistics centers elevated, especially if 2025 sees a recovery in vacancy rates and pricing. I believe this sector has a very bright future. This may not come as a surprise in light of what we just discussed. I believe retail remains a great place to be, especially REITs that deal with cost-conscious consumers and essential goods. Moreover, I believe hotels offer opportunities. However, in this case, I prefer luxury, upscale, and entertainment, especially experiential real estate is expected to do well. As RLA Global wrote earlier this year, ever since the end of the pandemic, we see that social media, e-commerce, and other online trends have not reduced our focus on having a good time in the real world. There are still great opportunities in these areas, even in light of poor consumer sentiment. Here are the picks I came up with. So now we're going to take a look at the three REITs that he's suggesting for the real estate recovery. So Rexford Industrial REIT, ticker REXR. This may not have come as a surprise, as Rexford is a REIT I have discussed a number of times in the past. My most recent article on the company was published on August 9th, where I called it one of the best ideas in real estate. Essentially, I like both Rexford and its larger peer Prologis, ticker PLD. However, only Rexford made it into this article as I prefer its valuation. What makes Rexford special is it focuses on Southern California's infill market. In this market, it owns over 400 properties, including over 700 buildings that cater to more than 1,600 customers. Okay, and with that said, I agree with people who make the case that California has challenges as it is one of the states that has lost a lot of high-income taxpayers to red states after the pandemic, including major corporations like Tesla, Chevron, Snowflake, and many others. So companies leaving California. Although this is a worrisome trend, I like Southern California for different reasons. For example, it is the fourth biggest industrial market in the world, and almost 4 times as large as Chicago and more than twice as large as New York, New Jersey. Interesting. This market is dominated by many clusters, including high-tech aerospace, and supported by top-notch colleges in the state that have created a favorable environment for innovation despite the many SoCal issues facing the state. The market also enjoys support from 2 of the biggest ports in the world, Los Angeles and Long Beach. These ports are critical for markets way beyond California. Even better, Southern California's infill markets have serious supply constraints on top of a tough zoning laws and increasing focus on residential real estate. It needs to be said that the market is wedged between mountains and the ocean. This gives the market tremendous pricing power. It's all about location, guys. Real estate is location, location, location. If there's no land to grow on, it becomes tight, and then valuations go up and demand goes up. Supply goes down, demand goes up. Simple economics. All of these tailwinds have allowed the company to grow its net operating income by 31% year over the past 5 years, roughly twice its peer average of 16%. This has provided 18% annual dividend growth during this period, 8 points above the peer average. The key question here is, will that continue, right? They've done that in the past, but as they've gained in size, will that be feasible in the future? That's the golden question that he doesn't really address in this article, but that's the question with any investment, right? If they grow fast when they're small, once they get bigger, it's harder to grow at those same rates. Currently yielding 3.3%, the dividend has a payout ratio of 71% and the support of very healthy financials. On top of the benefits that come with a BBB credit rating, one step below an A rating, the company sees 35% internal NOI growth over the next 3 years, most of it coming from repositioning, redevelopment, and market-to-market rent adjustments. Moreover, in light of economic challenges, it saw a higher occupancy rate and strong leasing spreads. Okay, so that's from his last article. Moving on here. Looking ahead, analysts agree with the company's upbeat forecast, expecting 11% per share of adjusted funds from operation growth in 2024, potentially followed by 14% growth in both 2025 and 2026. Using a 25-time multiple gives us a target stock of $62 and an annual return outlook of 12 to 14%. A 25-time multiple is pretty high for a REIT. 25 is high. That's like Microsoft's multiple. That's high. The next one here, the next REIT, Essential Properties Realty Trust, ticker EPRT. As we discussed in the first part of this article, retail REITs with a focus on essential properties remain in a great spot. This includes the REIT that has the word essential in the name. Now, really quick, guys, this is so important. When you think about e-commerce, when you think about real estate, it's all about disruption, right? What can you sell online that renders a local business obsolete, right? Something that you can't really outsource online is like a dentist. You're not going to go to a dentist online. You're not going to perform a procedure on yourself, right? You're not going to, like another one is like hair salons or nail salons, right? A lot of those that you actually physically have to go to. And that's where this term essential comes from, because it's not going to be easily disrupted. It is essential. It is necessary to human life and to society. And so that's why it's actually a very interesting way of looking at real estate, because when you think about investing, what's the moat? What's going to stop them or prevent them from being disrupted? Because you've seen that here in real estate. Even though real estate's still doing well, it's really taken a hit over the last couple of decades as customers are going to, e-commerce. And that's kind of where industrials come in and fill that gap, that need where you need more warehousing. So it's just kind of an interesting space, and how everything kind of ties together, and the ebbs and flows of real estate are really intriguing to me personally. Well, anyways, moving on. Essential Properties Realty Trust owns more than 1,900 net ease properties in 16 industries, leased to just about 400 tenants across 48 states. These properties have a weighted average remaining lease term of 14 years and are mostly sale leaseback deals, SLBs. Wow, 14-year lease term. That's really, really good for consumer facing or retail, I guess, right? 14 years is really, really good. A sale leaseback transaction is a deal where a company sells its building to improve liquidity. In exchange for this liquidity, it now has to pay rent to a landlord. In this case, the landlord is EPRT. SLB deals benefit from an environment of elevated rates, as many tenants prefer to sell their buildings instead of taking on expensive debt. Moreover, as we can see below, most of these transactions are in the essential areas like auto services, education, healthcare, convenience stores, and others. And so you could pause the video here if you want to take a look and see where the tenant industry diversification is for this REIT. Although I'm not a huge fan of renting to middle market companies, EPRT has done a great job finding the right tenants. As of the second quarter of 2024, it had a 99.8% occupancy rate, with no tenant accounting for more than 4.7% of annual base rent. Wow. So that's really, really good in terms of the occupancy rate and the diversification of their tenants and where their rent's coming from. Even though in their top 10 tenants, I don't consider Red Robin essential. I mean, maybe the guy going to Red Robin getting his Red Robin hamburger and fries thinks it's essential. But in my opinion, I wouldn't consider Red Robin essential. But that's just my opinion, I guess. Red Robin essential. What? What? Yeah, I'm going to Red Robin. They're essential. When you say that out loud, it's what are you thinking? Well, anyways, additionally, in the second quarter, the company invested $334 million across 35 transactions. These deals had a weighted average cash yield of 8% and carried a weighted average initial lease term of almost 18 years, with an annual rent escalation of 1.9%. That rent escalation is pretty low. That's not even in line with inflation. I don't like the rent escalation on this one. I much prefer it where it's pegged to inflation. And yeah, I don't like that necessarily as much. I mean, yes, cool, rent escalations, but that's not even 2%. Yeah, I'm not the biggest fan of that. I much prefer it tied to inflation. It also has a fantastic balance sheet, as it ended the second quarter with a leverage ratio of 3.8 times and more than $1.1 billion in liquidity. The dividend isn't bad either, currently yielding 3.6%. The REIT has a 61% payout ratio and a 5-year CAGR of 5.7%. Looking ahead, analysts expect per share adjusted funds from operation to grow by 6% this year, potentially followed by 8% and 7% growth in 2025 and 2026, respectively. Using the 18.5 multiple, we get a fair value stock price of $37, implying an annual return of 10 to 11%. Although EPRT has a lower yield than some of the bigger net lease peers, I prefer its growth profile and valuation, making EPRT a perfect pick for this article. So yeah, I mean, based off of the valuation today, I would prefer to wait for maybe a stock that I prefer more to come down in valuation than buying something now just because I like the valuation. That for me, I don't know. That's just my way of looking at it. Maybe somebody's a little bit more transactional. They get it at a lower valuation, then maybe they sell it, trade out of it. I was never investing like that. I was never good at investing like that, but that's kind of how I view that. All right, the third REIT is Vici Properties. When it comes to experiential real estate and luxury leisure, It is impossible to beat Vici Properties. The company even went with the title Invest in the Experience in the most recent investor presentation. If there's one thing Vici is known for, it's probably its massive footprint in Vegas. As we can see below, the company generates 74% of its annual rent from Caesars Entertainment and MGM Resorts, two of the companies that dominate Las Vegas. When adding the Venetian, which pays more than $270 million in annual rent, it generates more than 80% of its revenue from top-tier entertainment giants. Now, me personally, having experienced the great financial crisis of 08 and 09, I don't like that. These investments, they're great until they're not. They're great in a bull market. In a bear market, these kind of investments, they always would keep me up at night. Like, I would not be able to invest all of my money into Vici simply knowing that 80% of their revenue is coming out of Las Vegas. Having lived through the great financial crisis, I just could never do it. Now, could it be a small satellite position? Yeah, absolutely. But I would never go heavy into this. For me, it's just the risk is too great. Having 80% come from 3 companies, no matter how great they are, I don't know. It would keep me up at night. Maybe that's a flawed way of thinking, but for me, with that over concentration, I just personally wouldn't feel comfortable. It's like it would give me, MPW nightmares, right? With Steward, right, where they had their tenant Steward, their largest operator, representing more than a third of their revenue. Like, it's great until it's not, and that's how I view every investment. It's great until it's not. I should make a shirt like that. It's great until it's not, because that's my mantra now, is like, everything is great until it's not. Moving on, however, 53% of its rent comes from non-Vegas assets, including Caesars Atlantic City, Harrah's Lake Tahoe, and MGM Detroit, and many others. In Las Vegas, it co-owns major properties like Mandalay Bay, Luxor, Excalibur, New York, MGM Grand Park, MGM Caesars Palace. So really, like, the best of the best properties in Las Vegas. But one thing that you can't do is you can't deny the brands that they're working with. Like, this is absolutely like the creme de la creme when it comes to real estate in Las Vegas. What makes this business so strong is the fact that it's one of the few REITs in an industry with high barriers to entry. Its assets are differentiated instead of commoditized and protected by average lease terms of more than 40 years. The problem is that in order to grow, the company needs to focus on other properties, and it is hard to grow by adding mega resorts in Las Vegas. Hence, the company is expanding by adding bowling alleys, spa facilities, youth sports, and others. Although I do not really care for these assets, it's a good strategy to grow in areas with secular growth. 40-year lease terms. Holy cow. I thought 14 was good. 40 is amazing. I guess it's just, it's the mafia in Las Vegas, right? They control it. Holy cow. Even better is that these deals consist of favorable lending arrangements, including the option for Vici to own assets of companies enjoying strong secular growth. This includes Canyon Rack, I'm not familiar with it, a highly successful spa operator that offers a sale-leaseback opportunities. These operations are supported by a balance sheet with a 5x4 leverage ratio within the 5 to 5.5 target ratio and $3.2 billion in liquidity. Moreover, so far, these operations have allowed the company to consistently grow its dividend. Since going public, the dividend has grown 7% per year. Currently, Vici yields 4.9% with a 64% payout ratio. It has also beaten all major net lease giants when it comes to dividend growth. With regard to its valuation, Vici currently trades at a blended price to adjusted funds from operation ratio of 15 times, roughly a point below its long-term average. If we include expected annual per share AFFO growth of 3 to 5% using the FactSet data in the chart below, we get a fair stock price of $39 and an implied annual return of 10 to 12%. Despite its recent stock price rally, I believe Vici is one of the best REITs on the market, especially in light of secular tailwinds in their leisure segment. I believe the company has a promising future. I really like the idea of Vici. Just the over concentration is it's a little bit scary for me, but as a small satellite position, absolutely, I think Vici would be one to consider. I mean, how cool would it be to go stay at Caesar's Palace as a Vici shareholder and be like, yeah, I own this place, right? Like you own a percentage of this place. It's kind of a cool feeling. It's like every time when I go to the store and I see people buy Coca-Cola, it's like, yep, they're buying a part of a company that I own, right? Like that's what it means to invest into real businesses, right? So it's kind of a cool way of looking at it. So the takeaway, real estate is making a strong comeback with major ETFs up over 20% in the past year, largely driven by gains since April. Well, this is great news for investors. Rising valuations make it harder to find bargains. My deep dive into the commercial real estate market reveals stabilization, but also persistent challenges like rising vacancy and delinquency rates, especially in the office space. Despite these headwinds, opportunities exist in the industrial, retail, and hotel sectors with highly attractive picks that include Rexford Industrial Realty, Essential Properties Realty Trust, and Vici Properties. I believe these REITs leverage sector-specific strengths and secular tailwinds and are in a great spot for long-term growth, even in a tricky market economic environment. So that's the article. Let's take a look at a few comments. So let's take a look at the first comment here. I like Rexford out of this list and am a shareholder. As a Californian, I'm sympathetic to people who are wary of investments located in this state. There are plenty of issues, but I can also tell you that so much freight and industry runs through Los Angeles. The area is also so built up that there isn't much room left to build unless you start moving into the desert. Rexford has a nice near monopoly in the region on industrial space. Yeah, I mean, it ultimately comes down to supply and demand and, regulation. This could actually be a competitive advantage because it could prevent new entrants or new companies from coming into the area. It's just because, California is such a regulated state. I'm much more comfortable owning commercial real estate in California for the most part. I would never own residential real estate in California. It's just not a landlord friendly state. I mean, in Texas where I owned real estate, it was just, you had your lease and if anything went wrong, you went to a judge and, the tenant was out in just a couple of days. It's a completely different environment. And that is, there's reasons why people are hesitant to invest into real estate in states like California or New York or other areas across the country. Another comment here, I own Vici and Rexford. I looked at EPRT and don't like the tenant base as I think much is not a necessity and could falter in a recession. Wait, Red Robin's not a necessity? It's not essential? What? How dare you? Vici has top-notch clients, and for some reason, gambling seems recession-proof. And while it had setbacks with the pandemic, it came storming back with 3 great years. And I agree with all that's been said regarding Rexford, and so I took a position. Yeah. So when he's saying recession-proof and gambling, not really. I mean, and then Leo here responded to this comment. Gambling is not recession-proof, but that's okay, as MGM and Caesars and others are still paying the rent. Vici will be fine in a recession. Its stock price may decline, but the business will survive. So that's the article. Overall, I would give this article an A-. It does very well highlighting key pieces of information when it comes to the different industries that it discusses. When talking about the 3 REITs in this article, it touches on a lot of information, but it really sticks to more, surface level information. It doesn't really dive deep into the industry itself or into the REITs themselves. It gives very, very good surface level information. One of the things that I like most about articles like this is it highlights 3 REITs, 3 companies that you may or may not be familiar with. And it gives you good surface level information, and it acts as a good starting point to do a little bit more due diligence if you're interested in buying one of these companies or becoming a shareholder of one of these REITs. What it would not do is read an article like this and just then, based off of this, just jump head first and then buy the REIT tomorrow. I think this is a great starting point for you then to go and then dig a little bit deeper and do a little bit more research and to decide if investing into one of these REITs fits your investment goals and time horizon. Well, that's the article. Thank you so much for watching, everybody. I hope that the video was helpful. I hope that you learned something new, and I'll see everybody in next week's video. Thanks for watching.